The United States economy remains one of the better performers amongst Western economies at least, but some have a code red warning of a recession just around the corner for the US because of the yield curve inversion seen earlier in the year. What's all this mean and how should we be positioned? We're talking now to a widely recognized industry expert and author of a number of books about the financial markets, including this series Market Wizards, which has interviews with top market traders. It's Jack Schwager. Jack, welcome.
Thank you.
Of course, I should say this is the latest in a long line of Market Wizard books.
Over the past 3 decades, this will be the 5th.
So we'll pick up on what the trend has been that you've experienced in interviewing all these Market Wizards in just a minute. But I want to go back, if I can, to take a big picture look and your experience in the markets over the years. We've recently heard from the new IMF president saying that we're going to see a globally synchronized slowdown. So perhaps maybe it's not just the US, but what's your thought on where we are economically and for the markets?
Yeah, so I think that's a fair, I wouldn't argue with that assessment at all. There was a couple of obvious negatives. You mentioned the yield curve inversion. I think there's been 7 instances post-World War II where that has happened and it's led to a recession. It's been a very reliable indicator, but speaking from a statistical standpoint, we're still feeling only 7 points, and you have to allow that it's not always going to work. So it's definitely a warning sign, definitely worth looking at. The other element, which I think is well known but maybe doesn't get enough emphasis, is the whole trade war, which, while it started a bit ago, the impact is nowhere near. We're at the very threshold. So if Trump doesn't change his tune, then the repercussions of that will become increasingly bad. This is one of those things economists aren't good at predicting, but they're good at evaluating what certain actions will impact, what direction they'll have. And there's just no question that anti-trade policy, which has become rampant, is very detrimental. I don't think we've seen anywhere near the full effect. So you have the yield curve inversion, you have the impact of trade. You also have stocks are pretty highly priced from a relative value, PE value, any other metric you want to use. So there's a lot of reasons why we could be well forming a top.
That's an interesting point, because you say their economists aren't really perhaps maybe forecasting far enough ahead to get an idea of precisely what's happening. Markets, I'm told, are a good indicator of the future. But the equity markets, as you say, are up not too far away from record highs. They don't seem to be pricing anything about a recession into the markets at the moment.
Well, I think the reason why, at least the U.S. market is so high, a big part of that is because there was a tax cut that went, like 90% of the benefit went to the corporations, and that just increased earnings a lot. So I think that was a big driving force. And the thing to understand about that is it's the economy and the market are not the same thing. So that tax cut had maybe a brief sugar high, but a little bit of an influence, but not a big, because you're putting the money in the hands of people who already spend what they're going to spend. You're not putting it in the hands of people who will spend what they get. So if you did infrastructure, that would have a big long term, that would be bullish. But a tax cut which 90% goes to the corporation of wealthy doesn't do much for the economy, but it can do a lot for the stock market. So it's easy to understand why the stock market is here, because you really increase corporate profits by a lot. You've also had deregulation, which may have negative consequences because of externalities like increased pollution and all of that. But as far as the corporate profits and share prices go, it's positive. So it's quite easy to explain that.
To what degree have the central bank action as well had an upward effect on the markets? Because of this quantitative easing, I mean, we went into it not knowing what the effects would be. We were warned that inflation was going to race away in a few years' time. It didn't happen. Right. Here we are now looking possibly at a sort of Japanification type thing across global markets, certainly in Europe at least. Despite the QE program, there's no inflation for sure. What effect has that had in the markets? Has that had a supportive effect, do you think, on the equity markets?
Well, I guess it's the alternative. I mean, if you had interest rates at more normal historical levels, that would be potentially a drag. So the central banks do what they can do. Now, going into negative rates is a different story, but going down as close to zero as possible is actually probably a reasonable policy. In fact, when we had the near depression, the major recession in 2008, the response to that, the U.S. responded actually with a more accommodative policy more quickly, I think, and certainly fiscally. And I think that ended up being a better response in that situation. Of course, it's very different when you're in near full employment, which is, at least for the U.S., is which the situation is now. So the same policy would not be the correct policy.
Let's take a look at the publication of your books over the last 2 or 3 decades or so, and the Market Wizards book. I think your first book was, what, 1988, I think?
Yeah,
so,
my first Market Wizards book.
That's right, yeah, beg your pardon, of course, you go back before then. But what has changed, the interviews that you've undertaken with these people they have a proven track record within the industry, they're good at trading, they're good at what they do. What's been the change in messaging over the 5 books, or bring us up to date with what you're most recently?
Far more commonality of messaging than there is change, because the elements of trading successfully, that they don't change. So emphasis on risk management and having a plan, learning from mistakes, all these there's like 50 of them. Those type of messages don't really change much. What the markets have changed, and you may have now types of trading which couldn't have existed before. For the first Market Wizards book, these are not the type of traders I go after, but highly quant-oriented methodologies which needed tremendous computing power. Those couldn't be done back in when I did the first book. They now can be a major player in some cases. On the other hand, you have completely new types of trading methodologies that emerge which didn't even exist. For example, and this was a big surprise to me. I always thought that everything is you're either fundamentally oriented, you're technically oriented, or you use both. I mean, there is coin lands heads, coin lands tails. There's not a third alternative. It's not going to land on the side. So what I found this time, I actually found the trader who is neither doesn't use any fundamentals, doesn't use any technical. So that kind of sounds like that's a paradox. I mean, how can that be? And the answer is he only uses social media to trade. And so there you have a type of trading by definition which could not have existed a decade or more ago. So so the markets change, but the successful elements don't.
You're a specialist as well in the field of futures and hedge funds. How has that changed over the years as well, that part of the market?
Well, hedge funds, the obvious thing is, back in the early days of hedge funds, we could go. We don't have time to go into the whole history. I mean, actually, the history of hedge funds goes back to about 1948 with the first hedge fund. Yeah. But if we take more modern times, modern times, 90s hedge funds were really, pretty strong. Maybe even the early 2000s. But as hedge funds grew, the assets grew, it became more and more difficult to provide good returns. Plus, you had a really major bull market in some of those phases, and hedge funds, almost by definition, can't outperform they will underperform in a bull market. But the size of the assets is a problem. I think also a problem in terms of fees become more significant when returns are lower. So there have been those types of impacts that have made hedge funds less attractive. Although I believe now my expectation would be, I'm not going to call the high, but we're probably closer to some sort of relative high in the markets than we are to any big new up. I would be surprised to get a whole big new up wave. And if that presumption is correct and we start rolling over, then hedge funds would outperform. They may not make money if we have a down market, but they'll certainly lose less.
Yeah. Let's wrap this up and get back, if we can, to big picture, and indeed bring your expertise into the markets, because you are a technical trader, aren't you? You use charts and graphs in your trading. I know you've not been in the markets the last 2 or 3 weeks because you've been on the road. But what is your long-term prognosis technically on the markets?
Well, there are certain things in currency markets. We're seeing a lot of currencies towards the lower end of historical ranges, dollar towards upper end of historical ranges. So for a market like currencies, the long-term history of currencies, you tend to go in broad, long-term, wide ranges. And so if you're at a point where you're towards one end of the range or the other, then the bias should be to looking for, it may still, continue. You don't fight the trend. But the big trade from here would probably be something that would be long currencies other than dollar, against the dollar. Yeah. So I think if there's going to be a big trend from here, it's not going to be another wave of down in the currencies versus the dollar. It's going to be a change of that trend.
And in the equity markets, the indices, I mean, we're so close. We've been so close. We have record high to record high to record high.
It's so as a pure technical. Yeah. So you have a formation, and you can't define these things. Sure. So good chartists they're not predicting. They're interpreting what so they're ready for what might happen, and they interpret by what happens. So you have this big broad formation. It could very well be a major top. However, if you had the market go to new highs by a good amount, by not just go marginally new highs, but really punch out and consolidate, then as a pure chartist, I would have to say, okay, I thought it was a top, but we may be getting another upswing. So and that's the thing. It's not about being right in the forecasting. It's about taking the right action relative to what the market's doing.
Wise words. Jack, we've got to leave it there, but thanks indeed for joining us. That was Jack Schwager, author of Market Wizards.